Hi, good morning everyone. Welcome back to Value.Venture. In the previous video, we understood how total project cost is verified. Today, let us examine the next question. Does the money reported as spent actually correspond with the work completed at site? This is the reconciliation between cost incurred and physical progress. And these two figures should never be treated as identical. Suppose the verified construction and development cost is 100 crore. The developer says 70 crore has already been incurred. Does that automatically mean the project is 70% physically complete? Physical progress tells us how much actual construction work has been completed, and a better way to assess this is through a weighted workhead methodology. The project is divided into major work components: foundation, RCC structure, masonry, plastering and waterproofing, flooring, doors and windows, electrical, plumbing, fire systems, lifts, finishes, external development, and amenities. Each workhead is assigned a weightage based on its contribution to the verified construction and development cost. We then assess how much of each workhead has actually been completed. The basic formula is this: overall physical progress equals the sum of each workhead's weight multiplied by the percentage completion of that workhead. For example, if the RCC structure carries a weight of 30% and is fully complete, it contributes 30 percentage points. But if finishing works carry a weight of 20% and are only 25% complete, they contribute just 5 percentage points. Adding these up gives us a far more realistic picture of overall physical progress than any single glance at the building would. Now let us look at financial progress. Financial progress tells us how much of the relevant project cost has been incurred, but there's an important technical rule. If we compare financial progress with physical construction progress, both must relate to the same cost base. So financial progress should be the verified construction and development cost incurred divided by the total verified construction and development cost. We should not compare physical construction progress against a financial percentage that includes unrelated heads like land cost or marketing. Otherwise, we're comparing two completely different things. Now, suppose physical progress is 52%, while comparable financial progress is 70%. That 18 percentage point difference needs to be explained. It may be due to genuine reasons: mobilization advances, advanced procurement of steel or tiles, payments towards lifts or equipment, or other front loaded expenditure. But remember this: material purchased is not the same as material installed. So, advances and stored materials should be understood separately while assessing physical progress. The reverse situation is also possible. Physical progress may be higher than financial progress. A contractor may have completed the work, but the bill may still be unpaid, or suppliers may have extended credit. In that case, the work is physically completed, but there's still an outstanding cash liability. The same amount should not be added again to the construction cost if it's already been recognized. It should instead be separately identified as an amount still payable. Another common mistake is assessing progress only by the number of slabs completed. A building may have finished its entire structure and visually look almost done, but significant expenditure may still remain for MEP works, lifts, flooring, fire systems, painting, common areas, external development, and amenities. So, structural completion does not mean the project is financially close to completion. This single misjudgment causes some of the biggest funding surprises in construction finance. So, a good CF monitoring report should clearly show at least three indicators: physical progress, financial progress, and balance cost to complete, along with any significant advances, outstanding liabilities, and material procurement. The valuer's role is not simply to report the project is 60% complete. The report should explain what has been completed, how much money has been incurred, what is still payable, and how much money is still required to finish the project. That is the real value of physical versus financial reconciliation. And once we know the verified cost incurred and the actual progress, we can answer the next critical question: how much money is still required to complete the project, and is that money actually available? That's what we'll discuss in the next video on balance cost to complete and funding gap analysis. Please subscribe to Value Venture, and thank you for watching.